Money has always been the lifeblood of modern society. But in recent years, something alarming has been happening. Money is disappearing quietly, almost imperceptibly, from bank accounts across the globe. Unlike traditional financial crises where panic and chaos are visible, this is a silent erosion of wealth, occurring behind digital screens and official statements. Millions of dollars are vanishing, not through theft or obvious fraud, but through subtle shifts in banking practices, regulatory changes, and central bank interventions that most people don't even notice until it's too late. Banks, once seen as safe vaults for personal wealth, are now more intertwined with technology, policy, and global finance than ever before. With digital accounts, electronic transfers, and online payment systems, money has become almost intangible. This intangibility allows governments and banks to implement policies that can reduce account balances, freeze funds, or adjust interest rates in ways that quietly diminish the value of your holdings. Unlike physical cash, digital money is malleable. Its disappearance can be almost invisible until people start noticing lower balances, delayed payments, or sudden restrictions. The hidden crisis is amplified by the opaque nature of modern banking regulations. Central banks can inject or withdraw liquidity, influence reserve requirements, and introduce emergency policies that reshape entire economies, often without public debate. For everyday savers, these interventions can feel like an invisible hand slowly draining their wealth. Most people remain unaware because these changes are gradual and hidden within legal language, reports, and digital ledgers. This segment of the Silent Bank Run is a wake-up call. The financial system is no longer predictable or fully transparent. Understanding this hidden crisis is the first step toward protecting your money, anticipating the next moves of banks and governments, and navigating a world where your wealth may not be as secure as you think. Digital banking has revolutionized the way we manage money, making transfers instant, payments seamless, and financial tracking effortless. But with this convenience comes an unexpected vulnerability. The complete digitalization of our wealth creates an environment where money can vanish silently. Unlike cash, which is tangible and under your direct control, digital money exists only as entries in a bank's ledger. This ledger can be manipulated, restricted, or frozen at a moment's notice, giving unprecedented power to banks and financial authorities. In recent years, the rise of online banking apps, digital wallets, and fintech platforms has accelerated this trend. Banks can implement automated policies such as negative interest rates, maintenance fees, or sudden limits on withdrawals, often with minimal notice. Each of these changes chips away at the value of your money. And because transactions are now primarily electronic, these reductions happen quietly, without the physical manifestation that once alerted account holders. Moreover, digital banking increases the systemic interconnectedness of global finance. A crisis in one region or country can ripple through networks, affecting accounts in ways that are hard to trace or predict. Algorithms used by banks and financial institutions monitor account activity, adjusting liquidity and access in real time based on perceived risk. This surveillance, while designed to protect the system, can also lead to unintended restrictions on personal funds, effectively locking money in place during economic uncertainty. The role of digital banking in the silent bank run is therefore both enabler and amplifier. It allows for efficiency, but also creates the perfect conditions for wealth to be quietly eroded or frozen, leaving account holders powerless to react. Understanding how digital banking operates and recognizing its hidden risks is essential to protecting your financial future in a world where physical cash is no longer the primary safeguard. Central banks, often perceived as distant and abstract institutions, wield tremendous influence over the flow of money and the stability of financial systems. Their decisions, largely invisible to the average account holder, can dramatically impact how much access individuals have to their own funds. Interest rate adjustments, quantitative easing, and other monetary tools are not just economic mechanisms. They are levers that can shift wealth between classes, regions, and even countries, often without public awareness. One of the most critical but overlooked powers of central banks is their ability to implement hidden policies that directly affect liquidity. For instance, During financial crises, central banks may authorize emergency measures that limit withdrawals or redirect funds to stabilize markets. While these actions are often framed as necessary to protect the economy, they effectively place individual savings at the mercy of policy decisions. The recent trend of negative interest rates further illustrates this point. By penalizing banks for holding cash, central banks indirectly encourage fees and restrictions on depositors, quietly reducing the real value of stored money. Another subtle tool is the manipulation of reserve requirements and lending standards. Central banks can compel commercial banks to alter the flow of credit, affecting not only businesses and investors, but everyday consumers who rely on loans and mortgages. These interventions often occur behind the scenes, leaving depositors unaware of how policies are shaping the availability and security of their funds. Ultimately, central banks create a financial environment where money is never entirely under individual control. While they act to maintain stability on a macroeconomic scale, their hidden policies can contribute to silent bank runs, quietly restricting access to money and eroding personal wealth. Understanding these mechanisms is vital for anyone seeking to safeguard their assets in an increasingly centralized and digitized financial world. A silent bank run doesn't announce itself with long lines at ATMs or viral news reports. It creeps in quietly, masked by everyday banking operations. Detecting the early warning signs requires careful attention to subtle shifts in financial behavior, policy changes, and institutional signals. One of the first indicators is unusual restrictions or delays in accessing funds. Banks may introduce temporary limits on withdrawals, adjust transfer policies, or increase fees, all under the guise of operational or regulatory needs. These small changes often go unnoticed individually, but collectively they signal growing stress within the financial system. Another critical sign is an accelerated movement of money into alternative assets. When individuals or institutions start converting cash into gold, cryptocurrencies, or offshore accounts, it reflects a lack of confidence in the stability of traditional banking channels. Similarly, rising demand for high-security accounts, insured deposits, or private banking services can indicate that people are preparing for restricted liquidity scenarios. Pay attention to the behavior of commercial banks as well. Sudden tightening of lending standards, delays in approving loans, or unusual reductions in credit availability can precede wider financial restrictions. Central banks may also quietly adjust reserve requirements or interest policies, indirectly signaling that liquidity is being prioritized for institutional stability rather than public access. Finally, monitoring news about financial bailouts, emergency government measures, or systemic risk warnings can provide context for potential silent bank runs. These early warning signs, while subtle, collectively paint a picture of a system under pressure. Recognizing them early is essential for safeguarding assets, diversifying holdings, and preparing for a reality where access to one's own money may no longer be guaranteed. When a silent bank run is underway, the most important step is to protect your wealth before restrictions or financial instability prevent access. Diversification is key. Relying solely on a single bank or type of asset exposes you to risk. Spreading funds across multiple institutions, accounts, and asset classes can reduce vulnerability. Consider including tangible assets like precious metals, real estate, or other physical commodities that retain value independently of banking systems. Digital assets, such as cryptocurrencies, can provide liquidity outside traditional banks, but they come with volatility and require secure storage methods. Understanding how to safely store and access these assets is crucial. Offshore accounts or foreign currency holdings may also offer protection, though they require careful consideration of legal and tax implications. Another proactive measure is maintaining an emergency fund in cash or near-cash instruments that can be accessed quickly. Small, liquid reserves can help cover daily expenses if banking access is suddenly limited. Regularly monitoring bank policies, central bank announcements, and market indicators can also provide early alerts to act before restrictions intensify. Finally, knowledge and preparation are your strongest defenses. Learn how to move money safely, identify credible financial advisors, and create contingency plans. By acting strategically and early, you can reduce the risk of being caught unprepared, ensuring that your savings and investments remain protected even in an era of disappearing liquidity. and growing financial uncertainty.